Now, when we had some banks coming out and saying that we are at peak inflation and that inflation is topped and things are going to start coming back down. But for those that have been following us, and I had that question on Twitter, our view is that inflation was going to continue until June. And a lot of reasons on why, and we'll go through them piece by piece. But we always look at leading indicators because leading indicators are I think, hugely important when considering, the pace of something. And again, it's not all at once. Like, it's not like, companies look at PPI goes up and they immediately raise prices. There's a process that goes through. Well, do we have to, and based on margin, can we get away with not raising prices? If we raise prices, how much volume are we going to lose? Like, it's not just, price goes up, price pass through. In some places like that, there are some things like diesel costs, shipping costs is a straight pass through, but a lot of things aren't. And I think it's important because when you look at CPI, and we have that slide in a moment. Core CPI wasn't as high as previous. But when you look at PPI for now, not this month, but for not for March, but for February, there was a little bit of a dip. And so we had a little bit of a dip, and it was still elevated. It was still growing. It just wasn't growing at the estimates that we thought. So when you look at PPI in general, so March PPI came in white hot at 11.2% year over year versus the estimate of 10.6% and 10.3% in the prior month, which was revised up from 10%. So on the core front, 1.4%. On the month over month, up 1.4% versus 1.1%. Now on the core front, it was up 9.2% versus the estimate of 8.4%. So you're seeing, again, another acceleration up on the PPI front or the producer price index. And again, that's looking back. So the CPI is looking at the consumer. So we want to turn around and look at, how are they coming up with prices? What are the prices that they're coming up with? What are the wages? What is the shipping? What is the logistics? What is the raw materials, the manufacturing cost? All of these things get kind of wrapped into a little bubble, and that's what we see. This is the key leading indicator. I was told I was crazy in 2020 and in 2021 that I was only looking at cost, that I wasn't appreciating inflation. And yes, we can get into the debate on monetary policy and the creation of inflation. But I'm looking at what is happening right now and how are people factoring in what prices will be going forward. So headline PPI inflation surged 11.2% in March, while core PPI inflation firmed to 7%. This will grab all the attention, but again, it's more important to look at the faster sequential momentum in core PPI. Demand erosion from faster inflation and profit squeezes are going to be the ones to watch. And again, coming back to profit squeeze or margin, or how much are companies going to pass through? And how much passes through, again, leads to what is the CPI going to look like as faster inflation accelerates, creating some of these backdrops, which is why when we turn to CPI, you can still see it's vertical. It's just the rate of change. So March CPI coming in at 8.5% year over year versus the estimate of 8.4%. So prior month was 7.9. So we're still moving up. It's just, did we peak? And the answer is no. Like for us, now to be clear, March until June is key new job territory. It's when you can get it's easier to get a job. People are hiring. There's fresh budgets. People are figuring out what their headcount needs to be for the year. And you got your bonus, you quit, and now you're going to look to get a job for typically a higher salary. So wages are going to come into that. So you're going to get wage pressure coming through outside of commodities, as we talked about in segment 1, outside of energy prices. So now when we look at the other piece, so 1.2% month over month versus the estimate of 1.2% and 0.8% in prior months. So again, CPI is still moving up. Core CPI is where people are trying to spin this a bit. So core CPI came in at 6.5% versus the estimate of 6.6%. Again, prior month was 6.4%, so still moving up. Core came in at 0.3 versus the estimate of 0.5, and the prior month was 0.5. So the view is that there's the deceleration and that you're going to go essentially negative, because to say that we've hit peak inflation is to say that the next month is going to be negative. Now, for those that have gone shopping in April, you can attest to the fact that things have not gone down, they've gone up. My wife was just at BJ's, which is a Costco or Sam's Club, depending on what's by you. And, diapers went from $43.99 to, which were used to be $37.99. Now they're $47.99. You're getting that incremental walk up. It's not everything. It depends on, it's obviously going to be specific to what you're buying, but from creams and soaps and all of these other pieces outside of just food continue to move up. And I think this is always a funny chart because it's finally up, because the Fed always says we need to understand the wealth gap. Well, outside of the fact that real estate prices have gone through the roof, and if you owned real estate, you crushed it. But let's look at just corporate equities and mutual funds. So the top 1% own 53.9% of the percentage of total. Then of the 90 to 99%, it's 35%. So when you look at almost 85% of equities and mutual fund shares by wealth percentile are owned by the top 10%. Then the 50th to 90th percentile is 10%. So when you look at what happened from, obviously from 2009 on, but even if you want to go into a shorter time frame of March 2020 to today, there's your wealth. But again, I'll just bill them, and they can give me McKinsey wages. And the reason why we started with that is because now we look at the projected inflation tax. So it's the U.S. household has to spend an extra $5,200 this year. That's almost $450 a month just to maintain current. Now, the top quintile, which is why we're talking about that previously, is about $10,000. Now, they can weather that. Obviously they can lock in some gains, they can sell, they can use the paper gains to borrow, but it's when you start getting to that middle of the road, and that's when we start talking about who's going to fly, who's going to drive, because I have a family of 5, me, my wife, 3 kids. Think about flying. Think about the cost of flying when you look at where things are. Now, how does that get worse for people as they go down that line where, they're going to scrimp and save to take their family to a great vacation, and then you look at airline tickets and you're like, oh my God, where did those prices come from? And that's when you get that shrinkage because of the inflation push. Now, obviously, all of this is a huge tax. It hits the bottom more than the top, and we'll talk about that when we start looking at wages. But the other piece is, are we reaching a new peak of supply chain strain? And this is what keeps that inflation bid, because you're looking at a renewed surge in supply chain disruptions, a new surge in supply chain shortages on the commodity front. So when you start looking at transportation prices, this is where you continue to see a lot of these supply chain issues, which again is going to keep those prices elevated. Then when we shift that to the shelter inflation, it's picking back up. So when you look at owner's equivalent rent and rent of primary residence CPI, the shelter index rose 5% year over year in March, its largest year over year increase since 1991. So even if year over year house price growth slows over the coming months, shelter inflation will continue to increase for some time as shelter inflation lags observed rental and house price increases by about 1 year. So again, this is that kind of push behind the inflation numbers, because we're still just starting to see it, as we've been talking about. And as we said over the last few months, we expected it to accelerate, and here we are, it's accelerating. Now, when you start looking at, what were some of the drivers on why inflation missed? Well, used cars and trucks were down 3.8%. So you had an overhang. Now, we were still positive, even with used cars and trucks coming in as low as they have. Another piece, and when you look at the top 5 subcomponent contributors to US CPI, you had gasoline of all types. That's going to continue to come down, so that'll shrink. Then you had rent of shelter, which is, again, going to continue to come up. And then when you look at the remaining contributions, that kind of ebbs and flows. The remaining contributors is where we expect to see that continue. Rent of shelter continue as gasoline, starts to level off. Obviously, it'll depend on when things are struck because gasoline prices came down. Now crude is spiking back up. So we do expect to see this have some stickiness and move back higher. But then when you start looking at real weekly earnings, so when you look at the shift, you can see that we have now fallen in almost like a rock back through the trend higher. But when you continue to see that fall, so the distortion due to disproportionate layoffs of low pay workers. So when you look at the earnings, then U.S. weekly earnings quarter over quarter, we're now below 2%. So we're negative 2.1% on real weekly earnings. So inflation, even though wages are going up, inflation is far outpacing, impacting the amount people can spend. So right now they're going and getting more credit. They're going to do more things. But this is just another pressure point that has yet to really show up in the demand numbers. We're starting to see, again, retail sales have slowed, inventories are building. We expect that to accelerate as weekly earnings become a bigger overhang. Now, another key leading indicator is the small business compensation index, where things are shifting. So there's still a wide gap between small businesses that have raised compensation and percentage that plan to raise compensation in the future. So you can see that they're reaching this pressure point of how much can we continue to raise without impacting sales. And the compensation index currently is at the highs. And again, when you look at when do people hire, it's that March to June. And the market is white hot on the jobs front. So you have to pay up to bring those people in. But then once you get past that point, what are you planning to do in the future? That is where things start to get a bit softer. Now, when we start looking at the jobs hard to fill, still remaining elevated, but hiring plans going forward have fallen. So this is a slightly different variation of the chart we just saw. Job market remains tough to navigate for small businesses. As of March survey, 47% had difficulty in filling jobs, while 20% planned to up pace of hiring. So hiring is slowing. They're looking at this and saying, look, we're tapped out. We either can't afford it, we've hired enough people, and that again is that kind of leading indicator for the jobs slowing. And as the jobs slow, wages will also slow while inflation continues to grind higher. Now, another key component of the inflation story, mortgage payments. So mortgage payments growing at the fastest pace since the late 1970s. So the year-over-year percentage change in estimated monthly mortgage payments is greater than 30% currently, and it's the fastest growth rate since the late 70s, early 80s. What is noteworthy during that period is that the elevated growth rates were sustained for multiple years. At the same time, housing as a percentage of GDP grew, while equity holdings as a percentage of GDP declined significantly. So the question is, do we start to see that pivot? Now, given when you're looking at mortgage payments in percentages, a small number to a small number can be a big percentage, even though it's a small number, which is what we're working with. But it's just showing the stickiness and the staying power of these elevated prices, especially when you start looking at mortgage rates and yields, which we're going to talk about in a minute. So then when you start looking at, again, owner's equivalent rent portion of March CPI inflation rose at 4.5% year over year, surpassing the great financial crisis peak rate. And it's the fastest since 2002, which again is keeping the pressure on that inflation. And this is what you have to pay your rent, your mortgage, and we'll show why in a minute. Because when you look at people at the end of the moratorium, you're seeing a big increase in people getting kicked out of their apartments. So inflation expectations for 1 year ahead as still remains at 6.58%. But then when you look at the expectations in the 5 to 10 years out on the forward five year, it's still muted, and that's where we think there's going to be a bit of a surprise, where people are accepting it's happening right now, but the expectation is that they're still going to get it under control. And while I do think there is an ability to get under control, it's going to take higher rates and much higher rates. And are they going to be willing to do that and because if they're not, that's when you're going to start to see that increase, and that fear, that bringing it higher, that's when you're going to get kind of the biggest bite into some of the underlying numbers. So then when you look at the CPI projection downgraded to 6.3% year over year in 4Q, it's funny because I wish I had snap charts of these, and I should probably do that because I have all the charts of estimates on how estimates essentially going back to, let's call it the summer of 21. Every year they had the dotted line and the decline, and then it would go up, and then they'd move the dotted line and then the decline. So we continue to see this call for peak inflation. And again, we keep talking about how we're just not seeing that peak piece where there's a lot, you could get a pause, which is possible. We thought we were going to get a pause in January and February before we got the reacceleration in March through June. Instead, we had that big surge, obviously with energy, Ukraine, Russia, pulling some of that forward. But now you have a lot of that stickiness that is just sitting in the system. And then when we look at the U.S. real disposable personal income as a 6-month percentage change, you can see that it's the real disposable personal income remains in negative territory. Real incomes have been contracting for half a year, and we haven't even started raising. We just once raised a 25 basis points. So it gives you an idea of some of the pressure that remains in the system as we look at what people are doing to change their spending patterns, eating out less, driving less impulse purchases, flights going to continue to be canceled. We're going to continue to see these impacting what activities people are going to do or what they're not going to do as the prices continue to move higher, also resulting in an increase in wholesaler inventories, which when you look at wholesaler inventory sitting at 2.5% higher, that's well above the estimates. And then when you look at the month on month, same thing. That trend continues to go up as people are essentially kind of passing over and just saying, look, as I showed earlier, you're starting to see that pivot where people are like, well, do I really need that impulse buy? And then again, all of those declines show up in the inventory numbers. But when you look at what people had, they had a lot of savings. They had a lot of this. They were able to pay down their credit cards. They were able to protect themselves. And now, as prices have gone up and their inability to spend or their wages, they're turning back to credit. So, but you can see there's still a certain amount of ability to get more credit, which is when you start looking at the as I've joked before. A U.S. consumer, you give them $2,000, they'll spend $5,000. That's still the case, and this is why, and we still have some of that. So even though I think retail sales slow, there's still a little bit more running room, which is why a little bit more inflation, a little bit more that the consumer will tolerate before we kind of get that steeper drop off. And when you factor that in, now one of the things that I agree with here is that it's not that the real disposable personal income is going to get much worse. It's just not going to get better. And it's because inflation is going to keep ticking higher as wages kind of tick higher. Then you're going to see them both kind of level off. And that's when you get that firm stagflation and that longer term pain, especially as the financially worse or better off from 1 year from now, you're seeing more people say much worse off and somewhat worse off is continuing to grow as wages aren't keeping pace and you're seeing those inflation numbers bite. Owner's equivalent rent of residency, you can see it's hitting pretty much everywhere outside the Northeast because the Northeast was insane already. So again, not as much to go up as other places continue to see and drive that higher. Now, small business higher prices. Ahead of this morning's CPI report, this came out where you've gotten the NFIB Small Business Optimism Survey. And there isn't a whole lot of optimism as the sentiment is roughly at a 2-year low. And then what's more important is 72% of respondents are raising prices, the second consecutive all-time high. So again, small businesses are raising prices again, and leading indicator. Again, now it doesn't mean that people will buy it. but they're going to try to push this through to cover some of those costs. But their concerns, small business sales expectations have fallen considerably and are at -18 in March and are at the lowest since the pandemic began, firmly at recessionary levels, again, leading to some of those pressure points. Then when you look at the average weekly earnings on an inflation-adjusted basis are declining by the most in data going back to 2006, highlighting how far wages are lagging behind consumer price increases. So if you start getting wages going up, then you have to raise prices further. So again, this is where you come into that kind of wage spiral that we've been talking about. Then when we turn around and we look at what does small business continue to lose confidence, March small business optimism fell to 93.2 versus the estimate of 95. And then the headline confidence which was in blue, is at the lowest since the pandemic began, but outlook dropped to its lowest in history of the survey. So going back to the 1970s, the outlook is the worst it's ever been. And I just think that it's worth to put that into context when you're looking at the pressure that the economy remains under. All the while, they send up selling prices and the compensation index kind of flatline. So again, those are some of the pieces that we're talking about. And now in the next segment, we're going to look at where people sit and what the Fed could really do to try to step in front of this oncoming freight train.